back to another tuition video. So this one we're going to be going over accumulation schematic 1. Now essentially what the schematic is a representation of how the markets go from weak hands to strong hands, and obviously weak hands being your average retail trader who doesn't really understand what's going on, to strong hands obviously being institutions, corporations, hedge funds, banks, whoever may be involved, just like a larger player, right? Now what actually happens is price comes down and there's high supply, right? And that supply through the schematic is converted into demand, which actually leads to the markup. And obviously, if you don't understand that, just refer back to the supply and demand video. And it's just a series of causes, and cause being the manipulation that you see within the schematic, which actually leads to the effect, which is the markup. Now, I'm just going to explain this illustration here because this is just like a nice way of you actually learning what happens at every point, and then we'll go on to a real life example where this is played out on a chart. And just something to note is that on the schematic on the schematic 1 you have a spring, right? So price will come back down, it will take out the secondary test in phase B, and then it will go back up. But in schematic 2 you don't have a spring. Price literally just consolidates, then it breaks out of the resistance, and then that's why you always wait for post phase D to ensure that the schematic is completed, right? Because if you just assume that this is a schematic 2, and like let's say for example you take a position here, you never know when the spring's gonna occur. So you gotta kind of like anticipate whether or not it may occur by always waiting post phase D in order to look for positions. So let's just get right into it. So in the preliminary supply, essentially what happens is price comes down with obviously selling pressure, and what actually happens here is there's early signs of large operators, like large investors, taking profits, which basically causes a bounce type of reaction. So people come down, price comes down, they take profit here, which literally relieves pressure from the market, and price goes back up to this point here. And then from here, price literally drops right back down, and then you have the selling climax. In the selling climax, the majority of like larger players who were in sell positions are taking their profits here, and you basically want this to be represented through like the largest volume bar, because that will basically show you the large selling activity that was going on. Because essentially what happens here is, because prices move so far to the downside, there's a lot of retail traders that have FOMO, so heavy selling starts to occur, and that heavy selling is basically absorbed by large interest. And if price closes well above the selling climax, that's just another good indication of that. Now, what actually happens is the same thing that happened at the preliminary supply. So price has the same bounce type of reaction to the upside, and that's called the automatic rally. And it's called automatic rally because they take so much pressure away from the market that buying pressure easily moves the market upwards. Okay, and then what you essentially get is the secondary test, and in the secondary test, price essentially revisits the selling climax, and it tests the supply and demand in that level. Now ideally you want diminishing volume at this level, and you want some form of equal lows created here, right? Because what actually happens next is price literally moves back up after it's tested the supply and demand region, and it comes back down to create the secondary test in phase B, right? And essentially the secondary test in phase B is testing the supply and demand levels, but this is where you kind of see the manipulation, because look at this, it would have taken out that low and this low as well. I mean, they're basically equal lows, so it would have taken out a whole bunch of liquidity at this level, and obviously the people who are selling here, they would have been taken out, because right after that what happens is price literally moves right back up to the upside. Okay, and I forgot to mark it up, but essentially after the secondary test you have an upthrust action here, and essentially what that is preferably a break of structure of the automatic rally, right? and it's just an early sign of strength, and it usually takes out the high of obviously the automatic rally. And again, it's just manipulation, just like the secondary test in phase B. Okay, and then basically what happens after that is the spring. Now the purpose of the spring is to basically take out the majority of buy side liquidity to the left. It basically wants to take out anyone buying on this side so they can get in at the best price over here, right? So it takes out the majority of buy side liquidity to the left, and it's basically the final bear trap. So people who are selling in this region are going to be taken out automatically because price literally just pushes to the upside right after that. And in this region, there was very, very little supply left. And this is basically the final opportunity for big investors to like get in at the most optimal region in the market, like, which is obviously again right here. And let me just see if there's anything I've missed out. Okay, yeah, that's about it. And then essentially what we have after that is a sign of strength. And before that, we have some last points of support where price basically just finds like a ground. And then we have a sign of strength. And the sign of strength is basically when we break above the resistance level. And that's when it's post phase D and the schematic is completed. You want to technically start looking for long positions after the sign of strength, and you want to kind of find a discount between the last point of support and the SOS. But alternatively, you can also do it if you have a spring printed, you can also do it from the spring. So you can obviously mark it out from the spring to the top of the new trading range and like wait for price to come into some sort of discount, find your entry that way. But yeah, that's obviously if you have a spring. So essentially, I'm just going to go into a live chart now. I'm going to show you how this basically plays. Okay, so this is Euro USD, and this is back in when was it, 20th of March, and I'm basically going to take you through illustrate where the different points were. So this was obviously our preliminary sell, right? Preliminary supply, preliminary sell, you can basically call it both. And what actually happened after that, the market pushes back to the upside and it creates the next point here. So what's this called? It was just a trick. This actually isn't called anything. So price pushes back up, and it literally does that because pressure is relieved from the market, right? And then literally what happens right after that is we come down and we create the selling climax here. So this is the SC, selling climax, right? And right after that, we have the automatic rally to the upside because the majority of traders, majority of investors have decided to take their profits at this level, which literally causes price to push back upwards. And then right after the automatic rally, we have the secondary test. And let me just ST. We didn't have a secondary test in phase B, but more better than that, what we actually had were equal lows printed, right? And what actually happened was this. We had obviously after the secondary test, when supply and demand was tested in the market, we had a push to the upside, and then price literally came back down, took out the equal lows, and then we had the spring here, like so. Now in this case, because we did have the spring, what you actually could have done was wait for price to create a new trading range. So obviously we broke some levels of structure here, and then you could have waited for price to come into some sort of discount, which would have obviously been within here. Now obviously in this case, this was our sponsored candle because that is the candle that took out liquidity, and I can't go lower than the 7-minute time frame on this because it's so far back in time, but it literally tapped the open of that candle perfectly, and then right after that it literally just ran to the upside. Okay, now I'm gonna actually go through volume with you because, as I said, volume and price needs to work in conjunction. So let's actually bring up volume. Okay, what's the first thing you notice? Okay, upon the selling climax, we basically had the highest bearish volume bar, right? And what you see, price creates lower lows, and even to this point, lower low. And what do you have? diminishing bearish volume. So let me just annotate this. Bearish volume diminishing, which means unsupported / unstable price action, basically, right? And upon the spring, right, you want minimal volume. So in this region here, you want barely any volume. Why? Because that's when the shift essentially occurs from supply to demand. Okay, so you want no supply or demand within this region. That's basically no supply and no demand. It's expressed through basically very minimal volume. So no supply / demand shown. Okay, and then literally right after that, look what happens. We create higher high, and what do we have? Increase in bullish volume. So here is where demand enters the market. Demand enters market. You have supportive volume indicating stability to the upside. So look how volume, and if you don't understand this, obviously refer back to the volume video. Look how volume works in conjunction with the price, with the schematic, okay? And then obviously after this, if you want to see just how far this went, we can play this out. And obviously if you didn't catch this trade here, you could have done it from the spring to obviously the top of this trading range, and obviously wait for price to come back into, like, for example, this sponsored candle or wherever it may be, and then look once again, push to the upside. And you can basically, even if you don't catch the trade within the schematic, right, because the schematic plays out, you have strong confidence in direction of price. You know to look for buys, and everything else after that just makes complete sense. Like, look at momentum here, right? Momentum to the upside, strong. Again, impulse, correction, and then again, literally what happens, price pushes to the upside. And look how again here we have lower lows created, but we have unstable volume, and then we have stable volume through. Let me just pause. We have now highs created here, and again we have stability in volume. So that's how basically how the schematics work. I hope that made sense. This is quite a daunting concept to kind of understand. So if you guys need to watch this video a couple times to understand it, feel free. If you guys have any questions, just drop me a message. And yeah, that's accumulation schematic 1. Just let me make sure I haven't missed anything out. Nope, that's pretty much it. So on to the next.